Okay, good afternoon. And I would actually like to start by thanking Momentum for the great partnership that Robeco has with them. And also I would like to thank in particular Sonia and Jeanette for the opportunity to present here our enhanced indexing strategy, which we see as an alternative to passive investing. And actually, I'm also very delighted to be here in South Africa, as Robeco actually is based in the Netherlands, to be in particular in Rotterdam. So it was quite a flight, but I'm happy to be here today. So let's start with passive investing. So in the past decade, we've seen that investors have increasingly been allocating to passive vehicles which have the objective to replicate particular indices. And let's have a look at an example how that works in more detail. It's actually quite straightforward. What we see here is an example of the 10 largest stocks in the MSCI World Index, which is one of the most well-known worldwide indices. And what a passive fund does is it buys exactly those stocks with exactly the same weights as the weights in the underlying index. Well, this trend towards passive investing is not strange, as passive investing has very attractive features. First of all, it offers investors access to the market premium at relatively low costs. Secondly, it's often a very well-diversified portfolio. And thirdly, investors know what they get in terms of returns and risk characteristics, so no surprises. Well, that also raises the question whether there aren't any drawbacks of passive investing. And we think actually there are. So we think there are a couple of points where actually a passive approach can also be improved upon. And in this presentation, I would like to highlight 5 of these points. So let's start with the first one. The first one is that the aim of passive vehicles is to replicate the underlying return of the index, but actually if you take costs into account, then the return is often lagging. And these costs can be relatively low, but actually they can also be high depending on the underlying index. And on this slide you find a snapshot from a handful of funds from the Morningstar website, and then you can actually also see the differences in these costs. A second concern, what I'd like to mention as well is that this return reduction is maybe not that important if you look at the returns over the last 10 years in equity markets, which has been actually quite high. Then you could say, well, maybe these costs are a secondary order effect. But if actually expected returns are much lower, as we observe or we expect for the next 5 years, and this is actually based on Robeco's outlook for equity markets, then actually every extra return is very welcome. So that also brings me to the second point I would like to mention, which is related to the characteristics of stocks. So a passive approach invests in all the stocks in an underlying index, while actually we also know from academic literature that there are stocks with particular characteristics that do better in the long run. For example, value stocks tend to outperform expensive stocks in the long run. So what you see on this slide is based on research from Robeco, and you see in the top 20%, these are stocks with very attractive characteristics, and you see the returns over a very long time period. So these are returns of stocks which are very cheap, which have high quality characteristics, low risk, etc. And then the stocks in the bottom, these are the stocks with the opposite characteristics. So these are expensive stocks, poor quality, high risk stocks. Well, as you can see, the stocks in the top, they clearly outperform the stocks in the bottom. And this is actually a confirmation of what we also know from academic research. But what I think is very interesting from this slide is that if you look at those bottom 20% stocks, they not only have a lower return than the average stock, but they actually also have a lower return than cash. And so if you invest in a passive strategy, then also 20% of the assets are actually invested in stocks with a poor negative expected return. So let's have a look at the third drawback I'd like to highlight. One of the advantages that's often being mentioned of passive approaches is that passive funds are very transparent. For investors, it's very clear in which stocks we invest in and with what kind of weights. And not only that, it's also known which stocks enter these funds at a particular moment in time, because it's announced in advance which stocks will enter and exit the index. These index changes, they are announced well in advance. Well, this transparency actually also therefore comes with a price, because it means that fast-moving investors like hedge funds, they can actually already profit from this advantage. They can already buy stocks for which they know there will be a lot of demand in the future because these stocks will enter the index at some moment. And there has been a lot of research to price movements around index changes of well-known indices. And I would like to highlight the results of one study, which is a study done by an American researcher. His name is Peter Gisto. And he has done this analysis for stocks that enter and exit the S&P 500 index. So this well-known US index. And what you see on this slide is the price development, the return development, I should say, of stocks that enter the index, that's the blue line, and stocks that exit the index, and that's the orange line. And you can see the return development around rebalancing date. So rebalancing date is actually the date that these stocks enter and exit the index. And 5 days in advance, it's actually known what are the index changes. So that's the announcement date. Well, what you can see on this slide is that actually the worst moment to buy the stocks that enter the index is actually there on the top. That's at rebalancing date. And this is, of course, the date if you have a pure passive approach that these stocks will also be bought in passive funds. So let me continue with the fourth point I would like to address, which is related to sustainability integration, also labeled SRI integration or ESG integration, because it's quite, we've not only seen this trend towards passive investing, but we've also seen the trend towards sustainability investing. And in our opinion, these two trends are very difficult to reconcile, because how can you actually integrate sustainability characteristics in a passive vehicle? You can, of course, exclude a couple of stocks, but not too much, because then you can get tracking error. And it's very difficult to reward companies that score well on sustainability. Well, obviously, there are also sustainability indices which are available, and that can actually be attractive alternatives. But these are active strategies which are wrapped in an index format. So it's also good then to evaluate these strategies as active strategies. So have a look at the tracking error of these strategies. Have a look at the sector or country deviations. Have a look at how concentrated these indices are. Well, related to ESG integration, I would also mention the point of governance. Because although there are quite some managers that offer passive vehicles or passive funds, still the majority of the assets is in hands of 3 large US passive managers. And that has implications for the governance of listed firms. And actually, on this slide, you find John Bogle. You could see him as the godfather of index investing. And last year, he also warned us for this, because in an interview with the Wall Street Journal, he actually mentions that a handful of giant institutional investors will one day hold control of virtually every large US corporation. So he is referring to, for example, the voting control that these passive managers in such a case have. And yeah, he actually calls public policy to do something with it, to actually act on that. So to summarize on this slide, the 5 concerns I've addressed. So first of all, that passive funds have the tendency to lag the index when taking costs into account. Not the most recent academic insights are included when constructing that index. These indices can be very prone to index arbitrage. It's very difficult to integrate sustainability criteria, and corporate governance is a concern. Of course, we also highlighted the advantages. So on this slide, you find both the advantages as well as the disadvantages. And wouldn't it be nice if we actually could have a strategy that still keeps these advantages of passive investing, but at the same time addresses these concerns? And that's actually the aim that we have with our enhanced indexing strategy. So in the remainder part of the presentation, I would like to highlight how this enhanced indexing strategy works and how it addresses all these concerns. What's good to mention is that this enhanced indexing strategy, Robeco has already been managing this since 2004, but actually, especially recently, we've seen an increased demand for these strategies, especially because of the points I just mentioned. And currently, the assets under management in these type of strategies is 360 billion rand. So how does an enhanced indexing strategy work? Let's have again a look at those 10 largest stocks in the MSCI World Index. Well, an enhanced indexing strategy also takes those index weights as a starting point, but then we give a slightly higher weight to the most attractive stocks and a slightly lower weight to the least attractive stocks, and the other stocks, we keep them at neutral position. So the next question, of course, is how do we determine this attractiveness of stocks? Well, that's based on a lot of research. It actually starts with a lot of academic research in the 70s. Think about Markovich, who showed that for investors it's good to have a well-diversified broad portfolio, like the market portfolio. But actually since then, there has been a lot of research that shows that stocks with particular characteristics, like I just mentioned, like value stocks or quality stocks, actually in the long run do better. And to these type of characteristics, Robeco has done already a long history in research. Since halfway the 90s, actually we've investigated these type of characteristics, and since 2004 we've been integrating this in our first quantitative equity strategy, which is actually the enhanced indexing strategy. So what are the characteristics that we look at? Well, on this slide you can find them. On the one hand, we look at valuation criteria. So we prefer stocks which are cheap compared to their fundamentals, like book values or like earnings. But not only that, it's also important that these stocks have sound quality characteristics. And quality is, of course, a very broad concept. We look here more at the academic definitions. And one example of that is share buybacks. So if a company buys back shares, so conservative management, that's being rewarded. And if a company issues new shares, that's a negative sign. Well, we combine these value characteristics with momentum characteristics. And I'm actually not referring here to Momentum, the organizer of this conference, although they, of course, also have great momentum today. But I'm actually referring to the momentum of stocks. So that pattern that stocks that did well in the past 6 to 12 months, they tend to continue to do well. So they tend to be the winner stocks. We don't only look at price trends, but we also look at analyst revisions. So if analysts revise their earnings estimate or other estimates upwards, that's a positive sign. If they revise them downwards, that's a negative sign. Well, these characteristics, they are actually well known, and in academic literature there has been a lot of evidence that these characteristics have a positive relation with stock returns. At Robeco, we've also done a lot of research to that, also to the explanations of these characteristics. So why is it that value stocks outperform expensive stocks in the long run? And by doing that type of research, we actually also found ways of enhancing these type of characteristics. And the enhancement actually often leads to either a lower risk or a higher return. So I would like to give you two examples, one of value and one of momentum, in how we actually enhance these factor characteristics. So let me start with value. This was actually also one of the research projects during my PhD thesis. And yeah, I can talk an hour on this slide, but I try not to bore you with that and just try to summarize it. So there's quite some consensus that value stocks outperform growth stocks or expensive stocks in the long run. But there seems to be less consensus on why that is the case. And a large group of academics actually argue that these value stocks earn a higher return because it's a compensation they get for a higher risk you run when you invest in these stocks. And that higher risk is often related to distress risk. So value stocks are cheap for a reason is a well-known saying. So we also find that indeed value stocks are more prone to distress risk than the average stock. For example, value stocks have higher leverage ratios. But that's correlation. That's not yet causality. That doesn't mean that higher risk is needed to get that higher return on board. So by investigating that in more detail, what we did, and one of the analyses I would like to show you here, is that we split this group of value stocks into two groups. One group with a high distress risk and another group with a low distress risk. And we investigated the return of these two groups. So let's have a look at the return of these high-risk value stocks. And the measure that we use here to determine whether a stock has a high or low distress risk is credit spread. So the higher the credit spread on a corporate bond that's associated with the stock, the higher the exposure to distress risk. So here we find the return of these high-risk value stocks. And if distress risk is the explanation for the value premium, then we would actually expect that these value stocks with a low credit spread also earn a lower return. But that's actually not what we find. We actually find that these stocks earn even a somewhat higher return. Well, of course, credit spread is only one measure, but we actually looked at a whole range of measures. And for each of these measures, we actually find that the return of these low-risk value stocks is at least as high as that of the high-risk value stocks. And this has important implications, because this means that it's very unlikely that distress risk is the explanation for the value premium. But it also has implications for investors, because for investors, it means that you can actually better invest in these low-risk value stocks and not just in general any value stock. Because if you would buy these low-risk value stocks, you earn at least the same return, but with a much lower risk. So that's also what we do in these enhanced indexing strategies. We integrate this distress risk and prefer the stocks which have a low exposure to distress risk. So then let's have a look at another example, momentum. The fact that if you buy stocks, the winner stocks, they tend to continue to go up. So momentum is actually one of the largest anomalies in the academic literature. It is a really strong performing factor. However, it can also show a severe underperformance, especially when markets are reverting. So think, for example, about the dot-com bubble, where momentum strategy worked really well. It tended to buy the stocks that went up the most, and these were typically high-risk stocks, high-risk IT stocks, and these high-risk IT stocks, they tend to continue to do well, so momentum strategy worked fantastic. But then the bubble collapsed, and especially these high-risk IT stocks, they went down the most, and that caused the underperformance. So this momentum strategy tend to select stocks or styles that recently did well, but if the style reverts, and it can also be if you buy large-cap stocks, and then large-cap stocks actually tend to underperform in the next period, and that can also lead to a reversal. That actually causes the underperformance. So we build an enhanced momentum factor where we actually look at the return of a stock that's mostly driven by stock-specific news instead of these style biases. And I would like to show you with this graph how that exactly works. So on this slide, you'll find two stocks, stock A and B. And the traditional momentum strategy would actually have a preference for stock A, because it is the stock with the highest return. But actually, if you look at the risk of the stock as measured by market beta, then you actually find that stock A has also a risk which is twice as high as the market's. So it doesn't have any extra return. You would also expect that high-risk stock to go up more in an upward moving market. Well, actually, stock B has a 5% what we call stock-specific return. And that's actually very interesting, because that's more likely to be driven by stock-specific news. So we have a preference in our advanced momentum strategy for stock B. So what does that bring us? Well, on this slide, you find the one-year rolling returns of a momentum strategy. And the gray shaded areas are the periods where the market reverses. And then you can see that this momentum strategy has really difficulties in performing well. You see these drawdowns. Well, if you look at this advanced momentum strategy, you can actually see that we're able to reduce these drawdowns. It's not suddenly an outperformance, but at least the drawdowns are reduced significantly. And what we observe is that the momentum return, so the return on that strategy is similar as with a traditional momentum strategy, however with half the risk of that traditional momentum strategy. So this is another example of how we enhance on a more traditional momentum strategy. So to summarize, we find here the 4 factor characteristics that we look at. And what we do is that for all the stocks in the index, we download this data, we gather it, we construct the scores for these stocks, and then we rank all the stocks based on the total score on these characteristics. Well, these are the characteristics that we look at when we want to determine which stocks to buy, but it's also important to know when to buy these stocks. And for that, we use our short-term timing indicator, which is based on more fast-moving characteristics. Because when we take a position in this enhanced indexing portfolio, it's often at least a year. So it's quite important to determine whether to buy a stock now or next month, and to determine the most optimal moment for that. Well, a buy signal is when very recently, so in a very short period, the stock went down, because then it tends to go up again. So contrary to the more medium-term momentum effect, we find that if you look at the past couple of weeks, there's actually a reversal effect. On top of that, a buy signal is also when analysts were recently increasing their recommendations, when there's more liquidity in that stock, and also when there's a low amount of short interest in that stock, so when the stock is not shorted a lot. These are all buy signal indicators, which we use to determine the timing moment of a stock. So let me now explain in more detail how we build such an enhanced indexing strategy. So let's start with having a look at if the index would be this MSCI World Index, so a broad, diversified portfolio. We look at these 1,600 stocks in that index, but we also investigate 400 large and liquid off-benchmark stocks, because these can actually be very interesting candidates which at some point enter the index, and then we can already buy them in advance and have less problem with this index arbitrage effect that I mentioned before. So of those 2,000 stocks, we download all this data, this relevant data, these value and momentum characteristics. And on this slide, I show you just an example of 6 stocks. So not those 2,000 stocks, but just 6 stocks as an example. And we gather all the data. You see some examples here of value and quality momentum analyst characteristics. And what we then do is that we construct this total score, we assign a ranking, and we sort the stocks based on that ranking. So here you see some examples of top-ranked stocks, which are very attractive, and some of the stocks which are less attractive, according to these characteristics. And you can clearly find that those top-ranked stocks, on average, have a higher book-to-price, better share buybacks, better momentum, and stronger analyst revisions. Well, this is the outcome of the characteristic design. This is a ranking. But a ranking is not yet a portfolio. So the next step is to make this translation from the model output to an actual portfolio. So how we do that is that we take these index weights from the MSCI World Index as a starting point, and then we give a slightly higher weight to those most attractive stocks, so which have the most attractive ranking. And we do that with around 20 basis points. And at the same time, we underweight the least attractive stocks. And that brings us then in the end with a portfolio of around 750 stocks, which is this well-diversified, broad portfolio. Well, as you can see, this is actually a very transparent process. So for me as a portfolio manager, it's very easy to understand why a stock is in portfolio, why it's being bought or sold, why we do a trade in that stock. And to show you further this transparency, I would like to show you this demonstration tool that we built. And you can actually give any stock that you like. You can name any stock, and we can show you actually how it scores on these 4 different factor characteristics, and also what is the final ranking of that stock, and the likely position in portfolio. I would like to start with the Dutch stock, obviously, Heineken, because we like Heineken a lot, and maybe you like Heineken as well. But although we like Heineken, the stock is not extremely attractive. And why is that? Well, we can have a look. It means that if a 10% or 0% means actually that the stock scores really well on that characteristic, and 100% means it's very unattractive on that characteristic. So if you look at Heineken, then although it has quite a reasonable momentum, analysts are not so positive, and it also doesn't have very strong quality characteristics. The stock, not the beer. And in terms of valuation, it's mediocre. So that leads us to a 64% rank, bit in the middle, bit below that, and the likely position in portfolio is a neutral position. Okay, so thanks a lot. So let's go back to the presentation. We've just seen that we take really small deviations in terms of individual stocks from the index weight. What about sector and country deviations? Well, also there, we take really small deviations. So what you see on this slide is the deviations for countries. Actually, when we rebalance the portfolio, that's every month, we ensure that we only deviate 50 basis points from the weight of that country in the index or from that sector in the index. So really small deviations. So what about sustainability? How do we integrate that? Well, actually, sustainability is integrated in every step of the investment process. It starts already with determining the universe. So if you look at the Robeco strategies, then we apply also an exclusion list to that. For example, we eliminate controversial weapons from the portfolio. So this is actually step 1. So these stocks are not taken into account. Step 2 is that actually, if we look at the characteristics of the stocks, then we also take ESG characteristics, or environmental, social, governance characteristics, into account, and that's part of the quality theme. So one of the items, one of the characteristics in the quality theme is ESG, and that actually means that a stock with a higher ESG score also has a higher chance of ending up with an overweight in portfolio. Then the third part is in the portfolio construction, and there we make sure that the ESG score, so the ESG score of the portfolio, is higher than that of the underlying index. And it's good to mention that we make use here of data from our sister company, Robeco Sam, and they're based in Zurich in Switzerland. And they have built a very nice database in terms of ESG data that we use directly here in our process. And then the fourth point I would like to mention is that we have also a separate voting and engagement team based in Rotterdam that do the engagement and voting on behalf of our clients. But we also make sure that when we engage with a company, that we reflect that in the actual portfolio. So if a company is under enhanced engagement, meaning that we actually want that company to improve and it's currently breaching certain UN Global Compact principles, that we do underweight it in our portfolio. So it cannot be overweighted. If the engagement is successful, we remove the constraint, but if it's unsuccessful, it's likely that the stock is put on our exclusion list. And this is, of course, also a difference with a passive approach, where it's actually really difficult to remove the company if the engagement was not successful, because it's part of the index. So on this slide, you actually observe the ESG score of the portfolio, so on the developed markets and enhanced indexing portfolio versus the underlying index. The higher the score, the higher the ESG profile, and you can actually see that it's higher than the underlying index. And this is actually what we find continuously when we look at the portfolio through time. So what has this brought us investors in this strategy? Well, we've been managing this strategy, as I said, since 2004. And since then, the annualized return of the MSCI World Index has been 7.64%. What we here assume is that passive funds were able to replicate that return, but we subtract 10 basis points of fees, of costs for that. And we also show you the returns of the enhanced indexing portfolios, where we conservatively assume 30 basis points of cost. And then you actually find that the returns of the enhanced indexing strategy were around 80 basis points higher than that of a passive approach, and that with a very low tracking error of around 1%. Well, in emerging markets, we've also been managing this strategy since 2007, so over 10 years now. And although the absolute returns have been lower there, we also assume higher cost here, you can still see that the additional benefit has been significantly higher than the underlying index. Well, also in Europe and US, you find the results here. I think what's interesting to mention is that, in both cases, of course, we find the higher results, but in the US is often seen as a very efficient market where it's really difficult to get a higher return than the index. But actually also there you find that this enhanced indexing strategy works successfully. So to summarize on this slide, we have touched upon all the aspects of the enhanced indexing strategy. And the enhanced indexing strategy still has all the benefits of passive investing in the sense that it gives investors access to the broad market premium, very well-diversified portfolio, no surprises, and little deviations from the index, also in terms of sectors and returns. But at the same time, we also observed that we could address the downsides of passive investing. So we're able to integrate ESG criteria in the investment process. Corporate governance is less of a concern. We integrate the most recent academic insights. We aim for an index plus return, and index arbitrage is also less involved here. So of course you could say, you could believe me or not, I might be a bit biased, I acknowledge that, I like the strategy a lot. But let's have a look then, and that's how I would like to end, with a quote from Malkiel. So Malkiel, he spent a large part of his career at Vanguard, and you might know him from this book. It's a book called A Random Walk Down Wall Street. In that book, he compared actually investment professionals with monkeys, and it was not a very big compliment for investment professionals, maybe for monkeys, because he says, well, they are just as good as investing. So it's clear that he is a very big proponent of passive investing. But actually 2 years ago, he had an interview in the New York Times, and there he actually made a quote that he now advocates an approach which he calls advanced indexing, which is a smart beta strategy that aims to exploit inefficiencies and beat the passive approach. So it seems that even Malkiel, who has been a big fan of passive investing, is now convinced of the next step in the investment industry, namely enhanced indexing. So if even Malkiel can make the switch, then we probably can all do that. So thanks a lot for your attention.
Thank you, Wilma. Thank you for almost wrapping the day as you have. Given a bit of the time constraints, there have been a number of questions on Slido. Guys, I'm going to ask that you actually just get hold of Wilma one-on-one. She's going to be around for the wine tasting, I imagine, and ask her those questions. But thank you for
Maybe
that. We are going to move
question?
on. you want to try one question? Do we
let's
have
do that.
one question at least from the back, our moderator? By the way, I spent most of the class feeling like I should have been in standard grade class.
Or
'cause
maybe
this
that's
was like,
why you want to skip the questions.
it could be, exactly. Yeah. So let's see what you have at the back. I see a hand going up. Slower class, I wish. That was my son's comment, actually. Says to my wife the other day, how come Dad doesn't come home, at the normal time when other dads come home? And my wife just said, well, he just can't finish his work, at normal time. To which my son says, well, why don't they put Dad in a slower class? It's just you just confirmed that for me, Wilma. There's your question. What's keeping you up at night at Robeco with respect to your investment approach compared to return environment? Good question.
That's a good question, indeed. So what's good to mention is that although this strategy is able to generate stable returns through time, that it's not a guaranteed outperformance strategy. Yeah? So we see, if we look back at the past 14 years, and then we see that we were able in 11 out of those 14 calendar years to generate an outperformance. But that also means that that's not always the case. And then in a couple of years, we were not able to do that. And that's, for example, in times where we see that growth stocks do much better than value stocks, or in times that markets are reverting. And these are difficult periods. And yeah, that's of course, we know that that's part of it, but that's of course, that can keep me awake.
Cool.
Yeah.
Good. You certainly don't look like you had any sleepless nights of late, Wilma. So thank you so much. Let's give her another round of applause. Really appreciate that.